Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. I'm Scott Hansen.
I'm Pat McClain. Thanks for joining us.
That's right. Glad you're here with us as what is the first weekend in August, I guess.
Yes.
Yeah. Anyway, this is a financial program, and we talk about financial matters, retirement planning topics, etc. And
yep, just try to help people in their financial lives to get a little bit of peace.
Yeah. So glad you are with us, and I think you'll find this, if you're newer to this program, it's a little different than a lot of financial shows. At least
we think so.
We try to have a little levity with some things.
I do listen to a lot of financial shows, and a lot of them are just hour-long infomercials.
Oh, most of them.
Where the products are disguised. And if you're not
yes, it's exactly right. They are disguised.
Yeah, if you're not a listener to financial shows or have a background in finance, you can I can almost immediately tell whether they're selling indexed annuities, or life insurance as an investment product.
There's one ad that talks about if the market falls, if we go through another correction, you're going to lose 50% of your 40% of your account balance. You can't afford to lose that in retirement. So the answer is to take it out of the market and put it all in annuities.
Yes.
Like, okay, well, what about other risks in retirement, like inflation?
Which is a considerable risk right now. If you're worried about anything, it should be inflation. And by the way, if they compare back to the last market decline, you lost 40% if you had 100% equities, and I don't know how many retirees have 100% equity.
And like every other downturn, it recovered and went on to new highs.
Yes.
And I mean, the Dow, we were roughly around 35,000.
New highs again?
I like to think back when I started in the industry in 1990, July of 1990, the Dow Jones Industrial Average was around 2,400.
And it is today?
35,000. And I think through that, we had the Gulf War, the first Gulf War.
Yes.
Markets pulled back then. We had the what was that?
Long-term capital?
Whatever. Yeah, back in the late 90s. And the Russian currency crisis and all that stuff. The market had a major pullback. We had, of course, the dot-com. We saw roughly 45% pullback in the broad stock market. Then we had the financial crisis. We saw over 50% decline in the broad stock market. And here we are today with the Dow at 35,000. Now, I have no idea what the next year is going to look like, 2 years is going to look like, but I'm pretty confident that over the next 20 to 30 years, things will be substantially higher than they are today.
And by the way, the stock market or equity market isn't the only place your assets should be. So
of course not.
So when you listen to us talk like this, there are other alternative asset or asset classes than stocks.
But for the investor that has, let's say, 10 plus years before they need their dollars, there's historically been like no better place than owning factors of production.
Well, let's just put it this way. I don't know of a single pension fund that is actually buying indexed annuities.
You think?
Yes. They do use some hedges in there, but they're not hedging their whole portfolio with indexed annuities.
Yeah. And not that there's a place for annuities at times in portfolios.
But not the way they're sold.
The world would be better off without them because they're so often missold. Yes. That's kind of the bottom line. Anyway, we're glad to be here with you today. We've got a great program. We're going to take some calls. We also want to spend a little bit of time on what's been going on with China and what that means to investors, particularly those that own foreign stocks. And it's just been roughly $500 billion of market value has been lost in the last month on Chinese companies that are listed on our U.S. stock exchanges.
Yeah.
These aren't...
It's American Depository Receipt.
Yeah, that's right. It's just been amazing. So we'll spend a little time on that. And, of course, we'll take your calls.
And I don't think you could actually call them Chinese companies. I think they're Chinese government companies disguised as Chinese
Well,
companies.
That's what they're feeling like now.
Right?
That's the whole point.
Yeah.
It's just...
If you're operating a large company that is publicly traded in China, don't believe if you're operating one and you're in China, every one of those CEOs know that they are ultimately going to answer to the Chinese government.
Well, they know now. I was in China. When were the Beijing Olympics? Whatever that was. That was, I don't know, 15 years ago. And I remember talking to this Chinese guy. He says, he was asking if I'm going to set up a business in China. I'm like, I have no interest in setting up a business in China. But he said something to the effect of, he says, yeah, well, what happens is he says, you'll never make money on your first business because you'll establish a business, hire employees, whole factory, and then one day you'll show up and no one's working there, and you'll find there's the exact same factory across the street where they basically stole all your whole idea, everything, right? So then you start again, but then you learn how to avoid that. But he says the first time you always lose. You just feel it. Anyway, we'll talk about what this might mean to you as
we want to take
investors.
your calls.
Yeah, to be part of the program, 833-99-WORTH is the number to join here at Allworth's Money Matters. 833-99-WORTH. Numerically, it's 833-999-6784. We're starting off here with Dan. Dan, you're with Allworth's Money Matters.
Hi. Thanks for taking my call.
Yeah, glad you joined us.
Yep. Question I've got is we have recently inherited several $100,000, and we have a good mix of stocks and one indexed annuity we've held for 20 years and a seven-figure portfolio of real estate. Any suggestions in terms of how we should work with this roughly $500,000 to $600,000?
Where'd the dollars come from?
From my father's estate, and about a fifth of it came from a small piece of farm ground he still held. The rest of it came from half of what's left, about $200,000 from fixed income, short-term bonds that he complained about the interest rates all the time, of course. Mm-hmm. And the other half came from some Vanguard mutual funds that he inherited from his father in 1975.
And have you liquidated everything? Is it what you're receiving as cash?
That is accurate, yeah.
Okay. And we're typically a fan of that because, at least under current law, when you receive an asset through inheritance, the asset is the tax basis is stepped up to the fair market value, enables you to sell without any capital gains.
Yep, and that's why he never liquidated that Vanguard, because of that exact problem.
And do you have any debt?
We have real estate debt, probably $300,000 on a portfolio of probably $2 million.
And how old are you, Dan?
Old, but feel like I'm 35, but I'm 70. Thank you very much. He lived to be 100, so who knows what's going to happen in the future.
And so tell me about your, so you've got $2 million, you said you had $2 million in real estate and $300,000 of debt on that real estate. Tell me about the rest of the portfolio. How's it allocated?
Well, we have, in addition to those numbers, we have $500,000 currently in investments through different mutual fund families. So we've accumulated over the years, plural. That's about $550,000. Roughly $2 million in real estate. The debt is fixed interest between 3 7/8 and 4 1/4. So that's not going to explode on me. I lived through the 1980s when it did explode on people. And we just buy stuff we never sell.
In the investments, the $500,000, it is inside IRAs or 401ks or qualified plans?
Actually, it's about a 75-25. So we've rapidly converted IRAs into Roth over the last 5 years. 75% Roth, 25% traditional.
And inside that $500,000, how much is stock versus
100%?
100% stock.
Yep.
I kind of like your so if you looked at, and I assume that you're taking income off your real estate to live on. Is that
we are
a fair
somewhat?
Assumption?
Yeah. Our pensions, plural, Social Securities is between 65 and 75, and
what then? So ultimately, what would you like to see? So this is money you received from your father. You've already done a good job saving for yourself. You're secure. You're retired. You've got retirement income. Now you've got these additional dollars. What would you like to see? Where would you like to see these dollars go? How would you like to see them be beneficial to yourself, to somebody else? What's the plan there?
Well, I would like to set up everything we own personally are in 2 different revocable living trusts, but I would like to set up some kind of a trust maybe to benefit some pastoral situations. We could maybe finance a pastor going through seminary. That would interest me a lot. something for maybe our grandchildren, maybe incentivize so that they earn and or accredit X dollars in scholarships, and we would give them X dollars or Y dollars in funding for colleges.
And how many?
I remember how tough it was when I went to college, because I worked my way through college, 2 jobs, and that was no fun.
And how many grandchildren do you have?
There are 5, and that's probably all there'll be.
And how much money is it? You said several $100,000. How many $100,000?
In the IRAs and Roths?
No, in your inheritance.
In your inheritance.
It's going to probably cap out at 600.
So the reason I was asking, like, what do you want to see these, the ultimate purpose for these dollars? That's what's really going to drive the investment decision, because you gave 2 completely different type of scenarios here. One is some sort of program that will help finance seminary, it sounds like, for upcoming pastors, and you might want to do that.
Just a thought.
I know.
Yeah, that's how everything starts, is the thought.
And by the way, I like the way you're thinking about these dollars, because money's a funny thing, right? And if if all of our focus is just let's see how much we can accumulate by the time we die, studies have showed that we have much more greater experiences with dollars. I can't even speak today. we derive much more pleasure out of experiences with our finances than we do with even just saving or spending on material things, such as helping your grandkids through their college and having some structure in some sort of education trust where they got to have some skin in the game and you can have some direction there, or helping fund something that's important to you, your the ongoing of your religion, essentially, right? And
so here's my first whack at it. You can take all this money and actually just buy equities with it. You add to your stock portfolio. But I would actually, and I've done this with many clients, and our advisors have done this with many clients, is to put an equivalent dollar amount based on a growth rate on the age of the grandchildren, which means this. Let's say that you wanted each one of the grandchildren to have $75,000 at their age of college to help fund the college funds. You would actually put in a different amount based upon the age of each child and an assumed rate of return to get to that $75,000. So you'd say, okay, the 1-year-old, I'm going to put $40,000. Yep. The 15-year-old, I'm going to put $60,000, right? So it's an equivalent number at age 70. Now, you'll never hit it right on the head, but you're going to get
pretty close.
You're going to get pretty close. So I would start with that thesis on the 5 kids. Then I would probably, you asked for my advice, I would probably pay off that debt at 3 7/8 and 4 1/4, 100% on the real estate. And then I would actually begin gifting into a charitable trust some of the appreciated assets in your stock holdings that is outside of a Roth or an IRA, to the tune of whatever you're comfortable with your pastoral needs, maybe $10,000 a year.
You can probably find a program out there that is a tax-deductible program that can accomplish 95% of what you're looking for.
That's right. Yep. So you can do it through your local church or parish or synagogue. And what happens is you're taking that highly appreciated asset and you're gifting that. You're not gifting cash. If you've listened to the show any length of time, you know we're a fan of using appreciated assets in a charitable trust. In fact, isn't funny is I was looking at my charitable trust yesterday. And look, when you say charitable trust, it could be $5,000. It could be $10,000. It doesn't have to be hundreds of thousands.
And you're
of
not talking about a family foundation. You're talking about you
right,
set them. But Fidelity has them. Vanguard has them. Charles Schwab has them. They're donor advised funds.
They're donor advised.
Local community foundations have them. Large nonprofits have them.
And the benefit of using those versus family foundations is they lack visibility for the nonprofits to look into.
Okay.
Well, they're just simple. They're
simple.
There's no additional tax that there is in family foundations.
So what you're going to find by paying off that debt, right? You're going to find that you have approximately an extra $10,000 a year plus more income.
No, my goodness, it'd be more than that. Probably $50,000 to $100,000 more.
Depending on how
depending upon the payments are. But this is the cost of money alone. which is going to be able to provide you increased standard of living.
If that's what you want.
If that's what you want, or but that's how I would swing at it. And if you need help figuring out the amount of dollars based upon the age of the grandchildren to achieve a number, and then you're going to fund it using a 529 plan.
Sure.
So what
I'm
we just
with those.
we just used 3 different techniques.
Well, the 529 plan that might not have the same restrictions that he would like, depending on how he.
That's
you can weigh all these things. There's the simplicity of it and the low cost of the 529s.
Well, you mean like a match?
Yeah.
He said match. Yeah, the 529s, but you can instill a match. You're the one that owns the
That's
529
true.
plan.
He's the one who.
Right? You own the 529 plan. You don't have to, at the end.
You can change the beneficiary. You got one of the grandkids is not doing so well at age 19, let's say, and more interested in car catalogs than college catalogs, and you can say you don't get any money.
Yeah, or I'm only going to give you money if you do this or this or this. You come and visit me twice a week, and that sort of thing. If that's if you want your grandkids to visit you twice a week. But,
that'd be okay. But
when they're young,
that's interesting.
Yeah, not when they're 19.
That's right.
But what we just did is we used to achieve the objective. We paid off debt. We used a tax strategy for both the 529 plans and for your pastoral needs, which is to fund it, ministry. And all of those would work. And then now your job is to get into the fine details of it.
Sure. Okay, I appreciate it.
That's how I approach it.
Yeah, I totally agree with that.
We've done it with multiple clients where they've received inheritances, and we figure out what the expected dollar amount will going to be at the time the child goes into college.
Yep, that's what I need. Thank you very much. I'll reach out. Thank you.
Thanks for listening to our show, by the way. And if you're listening to us by podcast, if you would be so kind as to rate the podcast.
Review.
Oh, we're not allowed to use rate. Are we allowed to say
called
rate?
Review. It's review. Everything's with review.
Oh, okay. So review the podcast.
You could say click somewhere to review or something. If you like it. If you don't, please don't bother.
Yes. But actually, if you don't like the podcast, why are you listening to it?
Dan's talking about his inheritance. My father passed away a year and a half ago, and I inherited some money, nothing close to that dollar amount that our previous caller had. And I'm being totally transparent here.
Your father passed away.
Yeah, a year and a half ago. Yeah. It took a long time, by the way. He did not have a trust, lived in the state of California, no trust.
And his son probably mentioned it, I don't know, dozen, 2 dozen, 3 dozen.
He was proud of me, but I was still a little kid. Like, what do I know? Like, right? There was still a bit of that. Correct. Yeah, because he did. It was kind of interesting. Some of the. But anyway, my point is, it took almost a year for the estate to get settled, and I've had these dollars sitting in an account. Not because I don't know how to invest them. I'm still trying to grapple with what I want to see these dollars accomplish. Like, do I want to just throw it in the rest of my cash and then kind of forget about it? Or do I want to have it for my grandkids someday? Or do I want to have it for my nieces and nephews? Do I want to, whatever?
Or do you want to have it for some interest that your father would have really loved, like hiking or Sierra Club and Scott's dad was an interesting guy because he was an urban hiker towards the end of his life. And so I didn't know this. I knew Scott's dad well. And Scott's father was a completely different person than Scott. Scott's highly organized, right? Very meticulous. And your dad was the greatest guy in the world to hang out with because everything was an adventure. But at his funeral service, his friend got up and talked about these urban hikes where they would walk from
in Los Angeles.
He did 2 days.
He did from the Watts Towers to the Century Tower.
And it took him 2 days, right?
They would once a week do these urban hikes. And he said the nice thing about when you're an old guy, you don't have to worry about whatever neighborhood you're. I mean, you're such an old man walking. Who's going to bother you? Is what he was saying. Yeah, he was an interesting character.
And his friend was telling me at the service how they would walk for 6 hours and then spend the night in a hotel in wherever part of the town they're in and get up the next day. And they called it urban hiking.
Yeah, he told me one day he took one of his grandkids. The grandson was, I don't know, 19 or something. And they were going to ride the LA's equivalent of the light rail, subways, whatever the system is. He said, well, we're getting in and whatever he was going from
that
one
was
place.
going to be the day's adventure.
Oh, yeah, the day with the screen.
For the 19-year-old.
Yeah, correct.
How'd it
and
go?
just to people watch.
How'd it go?
I don't know. Yeah. But you bring up a good point. Maybe I should just look at something like that. But I was just being transparent. And that's quite common when we inherit money from somewhere. Oftentimes we want to say, like, what would honor them?
Because there's emotion attached to it.
Yeah, for sure.
Which is an interesting thing, attaching emotion to a dollar. Although most people attach emotions to money.
Yeah, strong emotions.
Yes.
Let's continue on here. 833-99-WORTH. We're talking with Greg. Greg, you're with Allworth's Money Matters.
Hello, guys. Thanks for taking my call.
Yeah.
I've been listening to your podcast for a while now. I really appreciate some of the insight you provide, and so thank you for that.
Thank you.
I have 2 or 3 different questions, 2 or 3. I'm not sure if it's or and. The first one is whether or not our current nest egg is adequate enough to support us through our current lifestyle through retirement with a 2 to 3% distribution. Whether our asset mix of 65-35 stocks to bonds is appropriate now and going into retirement, and whether or not I should take Social Security prior to full retirement age. So a little background. I'm 62. My wife is 64. The kids are grown and out of the house, mostly on their own. We have no debt. We own our home outright and don't plan to move at this point since all the kids are local. I think it would take more than a pry bar to get my wife to move away. We're both in reasonably good health. Our combined income currently is about $210. I work part-time from home. I'm a private sector employee, so I don't have a pension. My wife works full-time for the state of California. She plans to work for at least 3 more years beyond her full retirement age, at which point she'll be eligible for a pension of about $3,100 a month, and she's also eligible for a Social Security of $2,700 a month. Currently, if I decide to take Social Security now, my Social Security benefit would be about $2,300 a month.
You're working part-time, correct?
I'm working part-time, and I expect that fluctuate greatly over time, and it's really up to me how much time I want to put in. So that's flexible.
But you're considering taking Social Security now? Prior to age 66, 67, your full retirement age?
Correct.
Yeah, that would not be a good idea.
Because you're limited on how much you can earn. It's what, about $18,000 a year, Pat?
Yeah, it's not.
Or is it a little higher than that now?
It's not much. It's not much.
And then you lose your benefit.
So that the answer to the Social Security is you wouldn't even consider taking Social Security until your full retirement age or you cease employment considerably, which is you have to be under that limit.
Well, that's actually good to hear because that was kind of my plan all along. But since listening to the show, I've heard your opinion on Social Security and, changes could occur.
That's right.
So that got me thinking.
You're limited. It's eight for 2020 anyway. It was $18,240.
So
you lose for every $2 you earn above that, you lose $1.
So that's off the table. Of this $210,000, and what do you have in your 401ks, IRAs, and other accounts, brokerage accounts?
So our total nest egg is about 2.5. It consists, like I said, 65 total stock market and bond index, 35 bond index and cash. It's primarily held within traditional IRAs and a 401k account, as well as a brokerage account and a small 457. We don't have any Roth accounts.
And how much are you saving on a monthly basis in your IRAs, in your 401ks, 457s, that sort of thing? Or on an annual basis?
On an annual basis, we're not saving much. We used to save a lot more when I was working full-time. Most of the income that we generate now goes to pay off our current expenses.
You pay off your current expenses. What do you mean by that? Do you support your lifestyle?
Correct.
Got it.
And how much are you putting in a year? So here's how the number works. And I would recommend you go to our website. We're actually running out of time here. We're going to hold you over the break, and then we'll recap at the other end.
Which we don't like typically doing, but this is an interesting. And by the way, so far, it sounds like you should have a podcast on financial matters because it sounds like you've done a great job.
You've done a great job. So we'll hold you over the break, and we'll be right back and kind of summarize and give some solid answers.
Yeah, and if you want to join our program, 833-99 Worth is the number. This is Scott Hansen and Pat McLean. Allworth Money Matters. We'll be right back.
Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast.
Welcome back to Allworth's Money Matters. Scott Hansen.
Pat McLean.
So we've got Greg on the line. Greg, you're still with us?
I am.
All right, good.
So we'll recap Greg's situation briefly.
We'll see if we got it right.
Yeah.
By the way.
So Greg wants to know if he can retire comfortably on a 2 to 3% distribution from his investable assets. His allocation is 65% stock, 35% bonds. He's 62 years old. His wife is 64 years old. He has no debt. His current income is $210,000. Greg works for the private sector. His wife works for government. Will have a pension at retirement. His wife is also eligible for Social Security, which, by the way, some people that work for the government are eligible for Social Security, and some aren't. So don't believe that you are just because you heard it on the show. Greg's wife's pension will be $3,100 a month approximately in 3 years, and Social Security at $2,700 a month. And Greg at full retirement age, it sounds like his Social Security will be anywhere between $2,300 and $2,500 a month. And he has $2.5 million saved in IRAs and Roth IRAs and brokerage.
Bunch of stuff.
Did we miss anything?
You got almost all of it right. So my Social Security at full retirement age would be $3,200. Currently, it would be $2,300.
All right, that makes a difference. Okay, so how much are you putting into your?
I mean, just from a quick and dirty, when you look at Social Security, is going to be between the two of them roughly $6,000 a month.
Mm-hmm.
Pension's another $3,000. That's $9,000. Let's just call it $100,000 a year coming from pension and Social Security.
Yep.
You take a 3% withdrawal on $2.5 million.
Yeah.
And you're
at 175. And so the way you go through the calculation is you start with that 210. And if you go to our website, allworthfinancial.com, and look under the 7 personal decision points, we have lots of information so that you can get to this calculation yourself. And this is how you go through the 7 personal decision points. You start with what you're living on now. What you told us is you're consuming 100% of your after-tax income in order to live today. And your question is, can I continue that same standard of living in retirement? So we start with the $210,000, and you deduct out of that everything that will go away when you retire.
But before that, do you plan on quitting work entirely?
Not for the foreseeable future now.
Well, let's do the calculation like he is going to and see if he actually qualifies then, and everything else there would just be...
Well, considering, I mean, the only thing that you're paying Social Security taxes on most of your $210,000.
Yeah, so that's $15,000.
And your wife is probably also contributing to a pension.
How much is your wife contributing to a 401k? And you contributing to 401k?
Yes, she contributes to her pension. She's not currently contributing to her 457. I currently contribute a few $100s a month.
Okay.
To my 401k, and that's it.
Okay, so let's just do the math. So you're at $210,000. You're paying 7.65% to Social Security. So right off the top, we're going to round numbers. We're going to take off $16,000. We're going to assume that your wife is probably paying $10,000 to $12,000 a year towards her pension. And so now we're going to take the $10,000 off. We've got the $210,000 minus the $26,000, right? Now we're at $184,000 is what your taxable what you're living on, which is your taxable income. If I, as Scott alluded to, if I add up your Social Security and your pension at full retirement age, you're going to bring in approximately $110,000 a year. And then I add 3% of distribution on your $2.5 million. That puts you at $185,000. I'm quickly doing the math. If you're not tracking, go to our website, allworthfinancial.com. Go through the 7 personal decision steps for yourself. I'm talking to the rest of the listeners here, Greg. Because this is the same process we wrote. We wrote this process at Allworth because it's an easy to understand process, and it's the number one question we receive, which is, what will my income look like compared to my income today in retirement? So the numbers I did is you're living on $184,000
pre-tax.
Pre-tax. The information that you actually just gave me, with
Same
all
number.
your assets, it's $185,000. So yes, your standard of living, with all things remaining equal, will go up by $1,000 a year in retirement at a 3% distribution from that $2.5 million.
Okay.
You're good.
That works for me.
You're perfect.
And your wife's you still have a few more years before you're going to be, I mean, you've hit the point now, Greg, where work's an option and not an obligation. Now, granted, your wife's got some pensions she's still kind of working for, so that's helpful. But you're in a point now you can both say, like, I'm working because I'm choosing to work, not because I have to work.
Yeah, and it's best if you retire at least full time, relatively close to each other, just so that the animosity in the household doesn't rear its ugly head.
And you asked about the allocation. Look,
How long have you had it, 65-35? And did you make any changes through any of the downturns in the market since you've been investing?
We probably were a little bit more aggressive 10 years ago or so.
You were younger.
Have weaned it back. Now we're looking at. I'm comfortable at 65-35.
Yeah, then I am too.
I am too. that's
the reality is, look, that's 65%. You're not going to need to touch that for at least a decade. And markets go through cycles. We just don't know when they're going to start or when they're going to end. But you've got time on your side. Even if you retired today, you're not going to spend 100% of your savings in the first year.
Yeah, you are like the poster child of the person that has actually managed their.
I know, that's why I said he should have his own podcast.
Yes,
telling people how he got to that thing. So anyway, appreciate the call, Greg. If you'd like to join our program, 833-99-WORTH. We're talking with Tom. Tom, you're with Allworth Money Matters.
Hey, thank you, Scott and Pat, for taking my call. I was hoping you could help me with a Roth conversion plan. I feel I've made an error over the years of not doing so, and I would like your opinion on what to do now.
Alrighty.
I have approximately 800 in a rollover and 200 in a traditional, so a total approximately $1 million. And I turned 65 this year.
Any of those after-tax contributions into the traditional IRA?
In the traditional, yeah, about 60,000.
Okay.
Over the years.
All right.
And are you on Social Security yet?
No, I'm a year and a half away from that.
And what's your
retirement?
Are you married or single?
Single.
What's your ballpark annual income?
I'm retired, so I'm living off dividends and interest right now, about 50.
How much?
50.
And how old did you say you were? Or did you say you were
65 this year?
Yeah, turned 65 this year.
Yeah, based upon the note here on my computer, you live in California. Do you plan on staying in California the rest of your life?
That's a good question. I don't know. I'm renting now, and I may move, but I'm not sure.
Because that weighs heavily on how much you should convert to a Roth, if any, because California has got some of the highest taxes in the nation, very progressive tax structure. So I'd hate for you to convert to Roth and pay 7, 8, 9% to the state of California, and then you move to a state where there is no income taxes or it's very low, and then you just...
And you're not taking any distributions from these IRAs?
No.
And how much do you have in other savings that you get?
Quite a bit.
Interest.
Well, 3.3 total.
Okay.
Including the IRAs.
So another
2.3.
Yes, 3.3 total.
Got it.
Everything.
I don't think it's possible to have a plan to convert your $1 million IRA to Roth. What I do think is possible is that each fall you take a look and say, and do a little pro forma, like tax return, like where would you land right now? Look at the current tax rates and make a decision each fall. How much money should I convert from my IRA to a Roth? And because the way the tax brackets go, it goes from 12% to suddenly to 22%. Right? There's a big
and you want to take advantage of those gaps. So it might be 10,000, it might be 20,000, it might be 30,000. But in saying all that, if you did that and then 6 months later moved to Nevada, Washington State, Florida, Texas, even lower income tax states such as Arizona or the other of the states, all of them.
Except Hawaii. I think Hawaii
and New York.
In New York City. I think you got to be in the city.
Yeah. But any of the other states, then it would have been a mistake. And so
could have been.
Could have been.
Because your income's low enough now, even it would probably still, if you're in a 12% federal bracket, the way you got to do it is just run the numbers.
Yeah, and do you do your own tax return?
No.
Okay.
It's worth it to have a meeting or even it's a phone or Zoom call with your accountant each fall to do this.
Yeah, and just ask the question, how much should I convert this year?
And run some numbers.
Or a good financial advisor would be able to tell you as well.
Yep.
But especially before you start Social Security. You know, and I got to tell you, your net worth is $3.3 million. You're renting a home. Would I start Social Security early because I was worried about means testing on Social Security for high net worth or high income people?
If Tom were my brother, I would say take Social Security for sure.
Because at $3.3 million, he's single. So the
you have to live to normal than your life. You have to live to a greater than average life expectancy for it to pay off to wait. First of all,
that's right.
That's assuming that nothing is ever going to change, which we already know something's going to change. Because the Social Security Trust Fund's going to run out sometime around 2030, 2031.
So in fact, right now we're doing Social Security workshops. In fact, we've got some coming up in Denver and Cincinnati in the next week. We're doing Social Security workshops. And one of the things that we talk about the Social Security workshop is legislative risk. And what Scott and I are discussing right now with you now, which is what does legislative risk actually mean? And that means is that they change the rules.
But fortunately, there's no one in the political environment right now that are trying to target wealthy people.
So
we're not seeing that anywhere. They don't want to increase taxes on any people that are savers.
So I was watching a.
If you look where Tom is on a bell curve of 65-year-old retirees, you are a fat cat.
You are the one that they're going to take benefits away. So I was watching a video of Elizabeth Warren interviewing the gentleman that started Home Depot, one of the founders. And his argument to them was, you're talking about a wealth tax. And he said, my wife and I receive over $60,000 a year in Social Security benefits. I'm in my 80s. He said, it is a rounding error. He said, but no one. Now, this is a guy
offering it up to.
Yeah. He says, no one in Congress is going after Social Security, but you're going after this wealth tax. And he said, the problem with wealth tax is that it's not all lists, and how do you calculate it, and many of it's stuff.
Mess, yeah.
But he said, why don't you go after the easy stuff first? This is a billionaire who says, go after the easy stuff first. Take a number and lower Social Security benefits for those people over a certain number. His argument. Chris Christie made the same argument. Why are we paying Social Security benefits to someone that makes $1 million a year?
I think it was $100,000.
So the question is, what is that number, and will it be based on wealth or income? And by the way, you're going to actually have to start taking required minimum distributions at age 72. So I would make the argument, I know you didn't call about this, but I would make the argument, as would Scott, that go ahead and start taking Social Security benefits today because you're not working.
The same reason you want to take it, the same reason you believe that tax rates are going to go up. If you didn't believe tax rates were going to go up in the future, you wouldn't be talking about doing any Roth conversions.
Because it wouldn't matter.
Right.
So you believe you're going to be taxed higher in the future, and I think the same.
That's why I would consider Social Security.
Yeah.
Taking it now. In fact, I would.
Before full retirement?
Oh, yes, correct.
Take it today.
Take it today. I'd spend
full retirement.
Yes, because
every month you go is a month that you don't have that check.
Yeah, and it's legislative risk. If Social Security Trust
Assuming
Fund,
you're fully retired, right?
He is fully retired. Tom, Social Security Trust Fund runs out of money, and they say we're going to have to cut benefits.
It's right now. It's scheduled to something like 27% across the board, 23% across the board.
They're not going to cut benefits to 27% or 25% across the board. They're going to go to the people that actually have the most income or the highest net worth and take it from them, because they can't cut the 80-year-old widow who's getting $800 a month by 25%. It's just not going to ever fly. I am 58. I never expect to see a dime of Social Security benefit. And I've been paying in since I was 15.
Yes, you do. Because you're going to be normal retirement age within a decade.
I don't think that. I think that my income is going to be high enough that I'm hoping my income is high enough that.
Okay.
Right? Who are they going to take it from? They're not going to take it from the people that are living on it. They're going to take it from the people that are excess, and that's why I'd start it today.
Yeah. I appreciate the call, and obviously you've done quite well financially, so good for you on that. Let's now talk with Steve. Steve, you're with Allworth Money Matters.
Yes. Hi, gentlemen. Once again, thanks for being there all these years. Another guy that I listened to, a national show host all these years, he retired a few years ago, so you're now my go-to person.
Oh, good. Well, thank you.
Both of you and whatnot.
And that was Bob. Was that Bob Brinker?
That was Bob Brinker. That's correct.
Did he retire?
Yes, he did retire.
Yeah. His last radio show was that last weekend in September 2018.
Oh,
yeah. I really enjoyed Bob Brinker's show, with the exception he was a little harsh on people at times, but that just probably
anyway.
But I enjoyed his show for years and years and years as well.
How can we have help today, Steve?
Okay, well, I kind of follow on the last call about the Roth conversion, and you answer a lot of my questions there. First of all, yeah, I'm going to collect Social Security. I turn 66 years and 2 months in November, and I'm going to start collecting it. I got about $600,000. I'm thinking about doing the Roth conversion too, but you hit the nail on the head about I'm in California and I may want to eventually move to Nevada. So I thought about that it's a good thing to maybe wait until you make that move to another state.
If you think you might leave a high tax state in retirement, absolutely would do it. What are the rest of your assets like?
Well, even though I'm retired and I'm collecting a pension, county pension, and but I'm still, in the stock market, and I am fairly aggressive. I've always been of the note that I'm going to be a little bit more aggressive, even into retirement, than most people think.
Well, you've got a pension.
Yeah, I got a pension.
Yeah, it makes it easy.
Yeah, you don't need the income so much.
But then again, I did have to invade the IRA last year because family dynamics. I had a sister that desperately needed help. The pandemic ruined her business and her income, and I found out she was falling behind on rent, and I said, well, let's come to me now. I mean, that's what the money's for, and I rescued her in a big way, but it cost a lot in taxes. But that's what the money's for. I couldn't worry about the taxes last year. I wanted my sister to still have a roof over her head, not having to pay a $125 penalty each month on late rent. So, that's what I've done with the money, but I'm not having to invade it that much this year.
So you're thinking about the Roth IRA conversion. What's your total income without, you use the term raiding the IRA. We actually call it withdrawals. But
spending some of your savings.
Because raiding sounds really harsh.
Okay. All right, I better use a better choice of words.
How much is your income with the exception of the withdrawal from the IRA?
Monthly income right now, it's probably right at about only $2,500.
How big is your pension?
That's I got two pensions, one from the county and then a small one for my timber industry work many years ago and whatnot. They total about $2,600 a month.
And are you receiving Social Security?
No, he's going to take it.
No. I'll start that in about 4 months.
Is your home paid for?
Oh, quick check here. Family dynamics. I got my mother's home that I'm watching out for, but I have to live in a different community because my mom is in the same community in a care facility. So I'm having to pay rent here in El Dorado Hills so I can be within like 3 miles of her if anything happens. I cannot afford to move down to the house in Sacramento.
And what's the value of the home in Sacramento?
I would say right now about $550,000.
And when your mother passes, do you expect that you will receive a portion of that in an inheritance?
I will receive about 2/3 of that.
Okay.
I may not. Taking Social Security at your normal retirement age may or may not be the right thing for you to do.
Oh,
I don't know. I would go through the calculations. But kind of a rule of thumb is if you don't need the money, take it. If you've got tons of money and you don't need it at all, take it as soon as you can because there's a chance that they might reduce some of it in the future. But if you're kind of on, and if you need the money, then wait as long as possible. I mean, some people they have to keep working until they're 70, and then start Social Security then, and then you're kind of in the middle there, right? So,
exactly.
I would go through. I would go through some calculations before I. And I would encourage you to, like Pat just mentioned, not to be promotional, but on our website we've got a pretty good webinar on Social Security and our live workshops, and it goes through some scenarios that says based upon like if you want to leave a higher inheritance, here's how you should be thinking about it. If you don't, here's how you should be thinking about it. If you're concerned about the stock market, here's how you should be thinking about it.
So you do not own a home.
Correct.
So in a perfect world, if location didn't matter, when you inherit the money from your mom, go buy a house for cash in another state, and then you can live really, really comfortably on that $2,600 plus Social Security in a couple years, so about $4,000, $5,000 a month. And the IRA, you can just keep it on the side and use it when you need it. That's how I would actually, if you were sitting in the office with any of our advisors, that's what our counsel would be.
Yeah.
Okay, very good. All right. Well, I appreciate it, gentlemen.
Good.
Thanks very much.
Glad you called, Steve. We wish you well. And we have a few minutes left. And at the beginning of the program, we mentioned we were going to talk about China. I tell you, it has been, I mean, when China's economy has been growing like gangbusters for a couple decades now.
Which because anytime that comes to a little trip in the road, the government, well, it happens here in the U.S. too. The government has stepped in. They have the dark market lending. They have supported real estate time and time again.
I remember it was probably 20 years ago. I had a client said, "Hey, Scott, China seems hot. What do you think about us investing in China?" And sometimes investors get confused on what their overall objective is, right? Most people, they're at retirement time. They want to make sure they've got a good retirement income. They want the highest probability of not having to change their lifestyle during their lifetime. That's most people's objective at retirement time. But then sometimes people get confused and they watch CNBC or whatever and they think they should be doing. So we had this conversation about China. This was 20 years ago. And I said, the challenge is you can't invest the same way a Chinese national can, because as a foreigner, you can only invest in, it's kind of like a partnership where you've got, you don't, well, first of all, you don't have access to all the books.
Yeah.
But you're relying upon that company to share in the profits. It's a strange kind of dynamic, the way that these are structured. And so we've seen people invest in all kinds of companies. We've seen there are lots of Chinese companies that are listed on U.S. stock exchanges, the ADRs. And I think we really started seeing this last fall with Ant and Jack Ma.
Yeah, and Jack Ma.
I don't know if it was that long ago. It was going to go public, want to take this company public. Backed by a lot of Western investors. And it was going to be multi-billion dollars, going to be the largest. And then
and he did Alibaba too.
Yeah. And the Chinese government said, no, you're not doing it.
Not happening.
Not only that, we want you to stop doing this in your business, stop doing this. We want you to think about even breaking the company up. So it didn't go public. It was a big kind of, oh my gosh, in the investment world. And then since that time, if we look over the last month, what we've First, they came out and Chinese said some of these tech stocks, we don't like what you're doing. We don't like the privacy stuff. Ride-sharing apps, like just suddenly changing it, saying, oh, we're not allowing your app to be used anymore. Just essentially shutting down business. So we saw the value of those stocks go. And then we saw...
that's the government. So that's political. So there's always... Right?
Then there was these
risk.
Educational companies. That these educational companies, state says, we don't like the way you're doing education, shutting those down. That some of them fell 70, 80% in value overnight. Now we're seeing gaming companies. And so it's really interesting watching the state control...
Political risk in your portfolio.
That's what I'm getting at. It's the political risk. So anytime you step out of the United States, you're taking on one, currency risk, but two, political risk.
Yeah. And company risk.
Well, there's always the company risk.
The company risk exists everywhere.
And if you think about it, if you're a long-term investor, which you wouldn't want to own stocks unless you're a long-term investor, you got to be pretty certain that length of time, the political establishment is going to be relatively stable.
Oh, you mean like Venezuela when they just came in and...
You realize that 100 years ago, the turn of the 20th century, Venezuela was the fourth most highest productive country in the world.
I did not know that.
Number 4 as far as GDP. Venezuela, number 4, just over 100 years ago.
What is it now? 400 and...
I don't know. I mean, it's tragic what's happened there, obviously.
And it actually can happen at any point in time. It's hard enough to manage political risk in a U.S.-based company stock.
And look, we're fans of having a portion of portfolio in international stocks, but you just need to make sure you do it the right way. The people are thinking it was $500 billion in declined value in the last month of Chinese stocks listed in the U.S. $500 billion. A lot of people lost a lot of money. Anyway, we're out of time. It's been great having you with us. We are this same station each week, this same time, or of course our podcast. And we greatly appreciate our podcast listeners as well. Really do. Anyway, it's been good being with you. We'll see you next week. This has been Allworth Financial's Money Matters.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.